Welcome to the Deep Dive, where we slice through the noise of earnings calls to get you straight to the insights that really matter. Today, we're diving deep into the Q2 2025 earnings call from Hancock Whitney Corporation.
That's HWC, the prominent Gulf Coast regional bank.
Exactly. They just reported their results yesterday, July 15th, right after the market closed.
And held the call then, too.
Right. So our mission for you, our listener, is to not just summarize what was said, but really dissect why the market reacted the way it did.
Yeah, what it means for Hancock Whitney going forward.
And maybe what signals it sends for, the broader regional banking landscape.
Yeah.
Because this one, it's got a fascinating disconnect.
It really does.
Okay, let's unpack this. Imagine this. A bank posts what look like, pretty killer numbers. Beats on revenue, beats on adjusted earnings per share.
Looks good on paper.
Totally.
Yeah.
And then the market kind of shrugs, even sends the stock down a bit.
Yeah.
That's exactly what happened here. Revenue came in at $375.5 million, nudging past the $371 million consensus. Adjusted EPS was $1.37, beating forecast by the $3.
Pretty solid, right? Absolute solid headline numbers.
Yep.
But what's truly fascinating, like you said, is that despite these clear beats, the market showed a really distinct cautious reaction.
Yeah.
The stock actually declined on heavier trading volume the very next session. And this isn't just, a minor blip. It sort of spotlights this growing investor, maybe paranoia, about the stickiness of deposits across the whole regional banking sector.
Right. So it seems investors, maybe they welcome the clean headline numbers initially, but some underlying worries seem to weigh more heavily.
Definitely.
We saw some chatter around deposit attrition, maybe some one-time acquisition costs from that Sable Trust deal.
Could be part of it. And this cautious tone wasn't just Hancock Whitney. It kind of bled over to peers, especially those with heavier commercial real estate exposure, CRE.
Right, the CRE link.
Absolutely. If we zoom out a bit, connect this to the bigger picture, it just underscores the current environment where even strong headline numbers get scrutinized intensely for any underlying vulnerabilities.
Yeah, they're looking for cracks.
Exactly. Hancock Whitney, despite its fundamentals, almost became a bit of a bellwether for how quickly market sentiment can turn, even on what looks like a strong report. It signals a shift maybe from growth at any cost to stability at all costs for these regional banks.
Okay, so what does this tell us about Hancock Whitney's core business then?
Yeah.
Beyond just that initial market reaction, let's get into the specifics because the details are actually pretty compelling.
They really are.
Take net interest margin, NIM. Key profitability measure, right? It actually expanded by 6 basis points sequentially, reaching 3.49%.
Which is quite a feat in this environment. And it was largely driven by, two main things. Higher average earning asset volumes and yields.
Making more on what they lend out.
Exactly. And crucially, a continued reduction in their deposit costs. So they're paying less for the money they take in.
Makes sense.
For instance, their ability to reprice cash flows from the bond book at higher rates, we're talking $359 million, reinvested at 4.71% this quarter. That was a significant tailwind.
Okay.
Plus, you had fair value hedges contributing another 3 basis points. It really shows a disciplined approach, managing their balance sheet in this dynamic rate environment.
It does. And speaking of earning assets, loan growth also picked up, rose 6% on an annualized basis this quarter.
Yeah, about $364 million increase. Healthy.
Management highlighted stronger demand, increased line utilization, and actually lower payoffs as the key drivers.
Right.
And what's interesting is their focus on more granular, full relationship loans, trying to get better yields and more relationship revenue. It sounds like they're not just chasing volume, but quality.
Precisely, which is what you want to see. Now, on the deposit front, this is where the market maybe got a bit nervous. Total deposits were down $148 million.
Okay, that's the number that probably caught eyes.
It likely did, but you got to look closer. The devil's in the details here. This largely reflected a decrease in CDs, certificates of deposit, mainly due to maturity concentration and them reducing some promotional rates.
Oh, okay.
And also a decrease in public funds. But, and this is key, interest-bearing transaction balances and DDA, demand deposit accounts.
The cheap money.
The really cheap money, yeah. Those balances actually increased. Plus, their DDA mix improved to 37%, so it suggests more strategic repricing and a shift in the deposit base rather than just, outright flight.
There's a really crucial distinction. Maybe the market missed that nuance.
Very possibly. It takes digging. Beyond interest income, fee income also grew,
Right.
largely driven by trust fees, thanks to that acquisition of a stable trust company. Closed on May 2nd.
Okay.
That acquisition alone added about $3.6 million in trust fees for just a partial quarter. So you expect the full benefit in Q3.
Got it. More to come there.
Yeah. But it wasn't just M&A driving fees. Other areas like business and consumer deposit account charges, card revenue, treasury accounts, merchant services, they also performed quite well. Shows a nice diversified revenue stream.
Good to see. And expenses. Always important.
Tied into profitability, yeah. Adjusted expenses remain controlled, pretty much in line with expectations. This reflects, smart investments in new revenue producers and tech, but also just disciplined cost management.
So the efficiency ratio looked good?
It improved, yeah, down to 54.91%. That's a strong number. Indicates they're running a leaner operation.
Okay, so with those numbers in hand, the real test is what management's saying about the future, right? Are they as confident as this balance sheet looks?
That's the question. Let's dive into their guidance.
For the full year, management actually kept guidance intact.
Which is a positive sign in itself.
Definitely. They're still expecting low single-digit loan growth for fiscal year 25, which implies, a stronger mid-single-digit growth for the second half.
A bit of an acceleration.
Yeah. They highlighted net new loans to new clients as the primary driver. Interestingly, while C&D loans, construction and development, were down this quarter, they have growing commitments that should provide a tailwind into 2026. So pipeline's building there.
Right, looking ahead. And on the NIM and NI front, net interest income, they're anticipating modest NIM expansion still in the second half of 25.
Okay.
And NII growth between 3% and 4% for the full year. And this is important. They stated that even the impact of 0, 1, or maybe 2 potential 25 basis point rate cuts in the second half.
Which everyone's wondering about.
Exactly. Their guidance actually bakes in 2 cuts, September and December. But they said the impact would be minimal on NII and NI, like less than $1 million and about 1 basis point difference.
Wow. Okay. So they feel pretty well insulated from modest rate movements then.
Seems that way. And on deposit costs, they expect a marginal reduction in Q3, maybe a bit more in Q4, assuming those Fed cuts actually happen.
Right. Depends on the Fed.
But here's a powerful stat they gave. They had a strong 86% renewal rate on maturing CDs. And at lower rates.
Oh, really?
Yeah. $2.5 billion matured at an average rate of 3.85%, and they repriced those renewals at 3.59%. That's a direct cost saving. Should boost future profitability.
Absolutely. That flows right to the bottom line.
Yeah.
What about capital? You mentioned stability.
Rock solid. Ratios remain very strong. Tangible common equity, TCE, is at 9.84%. Common equity tier 1, CET1, is at 14.03%.
Those are big numbers.
Huge numbers. For you, as an investor, this isn't just jargon. It means the bank has a massive cushion against unexpected losses, way above regulatory minimums.
Fortress balance sheet, basically.
Pretty much. Gives them incredible flexibility. And they're using it. This quarter, they repurchased 750,000 shares.
Doubling their buyback activity.
Effectively, yeah. And they intend to continue returning capital at similar dollar levels, around $40 million a quarter, for the foreseeable future.
Yeah.
Flexible, they said, based on market conditions. They're comfortable operating with TCE around 8% and CET1 between, say, 11% and 11.5%, so they have room to keep going back.
That's a strong signal of confidence in their own valuation, isn't it? Buying back stock when it dips.
It absolutely is.
Okay, what about credit quality? Especially with all the CRE concerns floating around.
Yeah, good question. Net charge-offs, the loans they don't expect to recover, they were up this quarter to 31 basis points, a bit higher.
Okay.
But they're still expecting them to average between 15 and 25 basis points for the full year, so expecting improvement. And importantly, criticized commercial loans actually decreased by 4%. Non-accrual loans decreased by 9%.
So the problem buckets are shrinking.
Exactly. Management said they feel very good about their credit outlook. They see no systemic issues and, crucially, more resolutions than inflows in those criticized loans.
That should be music to investors' ears. Means they aren't seeing widespread problems, and they're cleaning things up faster than new problems are emerging.
Huge positive for future earning stability, for sure.
So they're managing risks well. But where does the growth come from? You mentioned loan growth guidance implies acceleration. They talked about an organic growth strategy.
They did. Sounds pretty aggressive, actually. Added 10 net new bankers this quarter.
Okay.
And solidified locations for 5 new financial centers in Dallas. 3 opening in the second half of this year, 2 in the first half of 26.
Wow, expanding into Dallas.
Yeah. And this hiring, they even said, quote, no ceiling on good talent, targeting 30 bankers externally. It's aimed squarely at driving future loan growth and getting them to their target loan-to-deposit ratio, that kind of 85-88% sweet spot.
Right.
They expect these new hires to contribute about 15% of total loan growth this year alone. It's a clear, strategic, long-term play.
And what about M&A? Always a hot topic for regional banks. Any change there?
Nope. No change to their stance.
Yeah.
They're not currently focused on M&A.
Yeah.
Their capital priorities are crystal clear. Organic balance sheet growth first, then shareholder returns via dividends and buybacks, and opportunistic M&A is a distant third.
That tells you they really believe in their internal growth engine.
It certainly does.
Okay, so this brings us back to the big question. We've just gone through a whole list of positive stuff. Strong NIM, solid loan growth kicking back in, disciplined expenses, robust capital, good credit outlook, clear organic growth plan. So
Yeah.
why the heck was the market reaction so cautious?
Yeah.
Is the market missing something huge here? Or are they seeing some ghosts that we're not?
That really is the million-dollar question, isn't it? It seems that narrative around deposit attrition, even if, like we discussed, it was nuanced.
Right, the CD runoff.
Yeah. That plus maybe absorbing those one-time acquisition costs, it just weighed disproportionately heavily on sentiment.
Yeah.
And look, this isn't just Hancock Whitney. We've seen similar reactions across the board in regional banking lately. Other banks, even with strong quarters, have seen dips because analysts honed in on maturing CD books or any perceived weakness in funding.
So it's a sector-wide sensitivity right now.
Very much so. It's a clear signal the market's prioritizing capital preservation and liquidity over just raw growth numbers, especially with interest rates potentially coming down.
So even with proactive management and those strong CD renewal rates they highlighted, investors are still hypersensitive to any hint of deposit movement.
It feels that way. Like the ghost of last year's bank runs is still kind of haunting the sector. Yeah.
Yeah.
And look, Hancock Whitney's management is clearly focused on this multi-year organic plan, emphasizing profitability, efficiency, their capital position, their diversified loan book. It really should provide a strong buffer against whatever the macro environment throws at them.
Logically, yes.
Yet, the market's focus on deposit stickiness and maybe the cost of growth in a potentially falling rate environment is just overwhelming that logic right now, even if management feels they have it under control, especially with that favorable CD repricing.
The market punished them anyway.
The immediate reaction was to punish any perceived vulnerability. Yeah. It just illustrates how, for investors, sentiment can sometimes totally override headline beats, especially in a sector like regional banking where perceived weaknesses like deposit flight can get magnified so quickly.
Fascinating dynamic. Okay, this is the segment where we lean into what's, let's say, outrageous but maybe plausible,
Yeah.
like a hedge fund analyst pitching the investment committee.
Okay.
And just to be crystal clear, this is not financial advice, purely a thought experiment based on everything we've just discussed.
Got it. Disclaimer noted. Okay, so given Hancock Whitney's Q2 results, that really curious market reaction, and the sort of sympathetic negative trading in regional peers with heavier CRE exposure, here's a thought.
Okay.
Consider a tactical long position in Hancock Whitney, ticker HWC, coupled with a short position in a regional bank ETF, specifically one that you know has significant exposure to commercial real estate.
Ah, a pair trade. Interesting. What's the thesis?
The thesis is basically that the market is currently over-penalizing HWC. They're focusing too much on what are, in context, pretty minor deposit attrition numbers and those one-time acquisition costs.
And overlooking the good stuff.
Potentially overlooking the strong organic loan growth restart, the continuous new M expansion coming from those deposit cost reductions we talked about, and their clear, disciplined capital return program, the buybacks.
Okay.
Meanwhile, the short leg, the ETF short, hedges against broader regional bank weakness. And it specifically targets those banks that might be less diversified or have heavier CRE concentrations, the ones the market is perhaps rightly worried about right now.
So you're betting HWC outperforms the weaker players.
Exactly. This pair trade would aim to profit from Hancock Whitney's specific fundamental strengths, letting them outperform a more vulnerable segment of the regional bank sector. You're essentially betting on their management's execution against this backdrop of broader market anxiety. Outrageous, but plausible.
Chuckles. It definitely fits the bill. Plausible rationale behind it. Okay, and that wraps up our breakdown of Hancock Whitney's Q2 FY25 earnings.
Yeah, we've peeled back the layers on a bank that, delivered on key financial metrics, has a clear strategy for organic growth, disciplined capital management.
Yet faced a surprisingly cautious, almost negative market reaction.
Exactly.
That tension between the solid operational performance and this investor apprehension, whether it's about specific balance sheet dynamics or just broader sector worries, it remains a really fascinating area to watch.
It really does.
It begs the question for you, the listener. Are investors seeing a genuine crack in the foundation at HWC? Or are they simply too risk-averse right now to appreciate what looks like a well-run regional bank when they see one?
Food for thought.
Definitely.
Okay.
So what stands out to you from this earnings call? How does Hancock Whitney's story inform your view of the regional banking landscape moving forward? As always, we encourage you to continue your own research and analysis.
And remember, the insights shared here, including that trade idea, are purely for informational purposes only. They do not constitute financial advice.
Absolutely. Thank you for joining us on the deep dive, and we look forward to bringing you more in-depth analyses next time.